Hi everybody, and welcome back to Chapter 7 in our second video. Here we're looking at that percent of sales method example. And here Musicland has credit sales of $400,000. It's estimated that 0.6%, remember that's 0.006 in decimal terms, of credit sales will eventually prove uncollectible. So all we do is we multiply that percentage times 400,000 and we get $2,400, which is our estimate of how much of those sales will prove to be uncollectible. Again, an estimate. So we're going to just simply debit bad debts expense and credit the allowance for doubtful accounts for $2,400. So now we're going to take a look at the receivables method. And the big difference is that when we use a receivables method, we need to consider what the existing balance is in the allowance for doubtful accounts. Okay, now let's look how we do that. We compute the estimate, which will give you an estimate of your bad debt expense. So we'll take our year-end accounts receivable times that bad debts expense. But in this case, we're going to, after we've calculated the total estimated bad debts expense, we're going to back out any previous balance to get our current bad debts expense. Okay, let's look. So in this case, Musicland has a $550,000 accounts receivable and a $200 credit balance in the allowance for doubtful accounts. So a credit balance is the normal credit balance, and I think of it as that which is not quite used up yet. So we're going to take 5% of $50,000, that gives us $2,500, but then we've already got $200 of it here. So we only need to debit bad debts expense for $2,300 and credit the allowance for doubtful accounts. Now when we do that, that adjustment here in the T account of $2,300, that adjusting entry will add to that unadjusted balance of a credit balance of $200, and that will total $2,500, which is what we want that account to be. A little tricky there, so you have to think about that for a second. And in the beginning, we had estimated $2,200 was going to be our allowance for doubtful accounts. But we had some write-offs here and here, so that's where the $200 comes from. It is possible, however, for it to be a debit balance. In which event, if it's a debit balance, we're going to add that debit balance to the $2,500. Okay, let's classify each receivable. In this case, we're going to look at another receivables method. I would argue the most prevalent. We're going to classify each receivable by customer and determine how long it's been past due. As that receivable ages, it's increasingly, exponentially increasing your percentage that you're not going to be able to collect that. So let's see how that works. Here is our normal schedule of accounts receivable by age. Here's our total receivables, $50,000, which we had previously. $37,000 of it is not yet past due. And we think 2% of that's going to be uncollectible, so that's $740. But now, this is 1 to 30 days past due. Notice that the percentage that we think is going to be uncollectible increases to 5%. So we take the balance in that column and multiply it times 5% to get $325. Then we have increasing age columns here. And as you see, the percentage dramatically increases when we get over 90 days past due. That's that's very indicative that you got a higher percentage of not being able to collect that account. So we add each one of these together, 360, 475, 370, 325, and 740, to get 2270. That's what we think is going to be uncollectible. But remember, we're not yet done. This is a receivables method. So we have to consider the existing balance in the allowance for doubtful accounts. And that balance here is $200 credit balance. So we get to subtract that $200 from the estimated $2270, the credit balance we want that to be when we're done. And we need to make an adjustment here of $2,070, which we do with a debit to bad debts expense and a credit to the allowance for doubtful accounts. When we do that, that will drive up, as shown here in this T account, the balance in the allowance for doubtful accounts to $2270, which is what we want it to be. Okay, when we do that, that's going to reduce assets and reduce equity, because that's going to be a debit to bad debts expense, which will then come over to the statement of retained earnings and reduce retained earnings. That's an expense. Okay, so now here we have a debit balance. Now, if you have a debit balance, that means we've had too many real write-offs against that allowance for doubtful accounts. So we now have a debit balance, which we have to overcome that debit balance and add another $2270 on top of that. So we need to adjust the allowance for doubtful accounts by $2770 here. Okay. So here, income statement focus, that's when we took a percentage of sales, and we don't need to worry about what's in the allowance for doubtful accounts. However, when we do a receivables focus, this is going to emphasize the realizable value of receivables. We can do it two ways, either a percentage of receivables or an aging of receivables. You'll get some practice with that in your homework. So I think this will become a little easier as you do it a couple of times. Okay, we'll change subject here and take a look at a note receivable. This note receivable is we want to determine its maturity date and how we record a note receivable. So here it's based on a promissory note. Accounts receivable is an informal agreement. Promissory note is a formal agreement. And it's a written promise to pay a specific amount of money, usually with interest, at a future date. Okay? And so here's that promissory note. And our maker here is Julia Brown. I think of this as like a checkbook, you know. Julia's got the checkbook and she's writing a check to TechCom. TechCom is the organization to whom Julia is going to pay. So here the amount's $1,000. It's due July 10th, and the interest rate is 12%. So let's take a look at that. Now, the number of days in July, here's July 10th. So I subtract 10 days from 31 days in July. My mother told me the following rhyme, which I've remembered all my life, and it goes like this. 30 days has September, April, June, and November. All the rest have 31. So July has 31 days, August has 31 days, September has 30 days. So I'm going to get 21 days, that's 11 subtracted from 31. 31 more days, I'm now up to 52 days. 30 more days. I'm now up to 82 days. And I need another 8 more days to get to 90. So that 8 more days is going to be a maturity date of October 8th. See how that works? Okay. The note is due and payable then on October 8th. So, to calculate the interest, we do this a little bit differently than you might think. We take the principal on the note, multiply it times the annual interest rate. At that point, I will have the annual interest. But we're only doing 90 days. So, here is the trick, if there is one. We express it as a fraction of the year, but we don't use 365 days. We use 360 days. We call that the banker's rule. So this calculation would be 1,000 times 12% times 90 divided by 360, and that will be $30. Now, notes receivable are usually recorded in single notes receivable account to simplify the record keeping. So the original notes are kept in a file with all the backup, including the information on the maker, the rate of interest, due date, etc. So here we are going to record that on July 10th now. We're going to record that as a debit to notes receivable, not accounts receivable, notes receivable, and a credit to sales. Now, when October okay, so now we're going to do it a little bit differently. Here, notes receivable in acceptance of a past due accounts receivable. So sometimes when a customer won't pay us on time, we say, okay, we want some interest if we're going to extend that, basically our credit to that customer. So we have them sign a note. In this case, TechCom is agreeing to accept $232 in cash, along with another $600, with a 60-day 15% note from Joe Cook to settle her past due $832 account. So you can see from this journal entry, we're going to move this accounts receivable, we're going to remove that and make it into an accounts receivable and accept a little bit of cash. So next, honoring and dishonoring of a note. Now in the last example, we had a $600, 15%, 60-day note receivable due to TechCom. So Jay Cook owes this to TechCom. So now when we actually collect this, we're going to make the note receivable go away. That note receivable had a debit balance and now we're crediting it to wash it out. We're also getting $15 worth of interest. We calculate that by taking $600, the amount of the note, times the 15%, times 60 divided by 360, and that gives me $15 of interest, and we debit cash to collect both the interest and the principal. But if Jay Cook does not pay us and dishonors the note, it doesn't relieve Jay Cook, the maker, of the obligation to repay the principal and interest. So we put it back up as an accounts receivable. We charge them the interest too, $615. We take the interest revenue that we've earned and the notes receivable we wash out. So now we've got this accounts receivable up for $615. Now, here TechCom's going to accept a $3,000 This looks like a good place to stop this video, and when we return, we'll take a look at this. Until then, bye for now.